Good morning, I'm Chris Wheaton. Welcome to Chart the Markets on IG Live. And it is, of course, US inflation day. US data for the month of January, price growth data for the month of January is released at 1:30 p.m. this afternoon. So markets are on watch for those figures in about 3 hours' time as we start this broadcast. Expected to see a further slowdown in price growth, dropping both on the month-to-month and year-on-year for the headline figures. Core slightly more unchanged, really. A lot of debate really how much January's rent prices and a few other factors will affect core CPI, which of course, if you remember, is the inflation without those food and energy components, which are viewed as more volatile and therefore they move around a lot more. So core is viewed as a more stable measure of where prices are. So that's the key event of the day. It's probably will set the tone for the rest of the week after a fairly quiet start to the week, because we're in that lull now when earnings season is very much winding down. We've still got Nvidia left really of the Magnificent Seven to report, but overall big names are out of the way. The Fed, we're still about a month away from the next Fed meeting, I think it is. And the Bank of England and ECB meetings are also some way off too. So markets find themselves slightly at a loss, a lack of major catalyst to drive things, save for today's CPI print, which is going to be the key one today. A bigger than expected drop could well enliven hopes that the Fed will cut rates earlier than expected. Not March. I think March is very much not happening, barring some kind of major change between now and the next Fed meeting, but maybe May. So that's the key thing to watch for in today's figures. Of course, if CPI comes in ahead of expectations, stocks do perhaps look primed for short-term weakness. Perhaps they've come an awful long way. You've got the S&P above 5,000, see in a second. You've got the Nasdaq above 18,000, the Nikkei breaking 38,000 in the aftermarket this morning. So they are very much on a high, and they've come an awful long way. They're risk of profit taking in the short term, which doesn't disrupt the overall trend, but it does leave you perhaps at risk of, if you're a late comer to the rally, of seeing a sudden turnaround that might knock maybe quite a bit off indices in the short term. We should note that as we go into the second half of February, not quite there yet, but we are getting in that direction, and into March. Usually the second half of February tends to be weaker for stocks generally, and March isn't a great year for US stocks in election years like this one. So there's an excuse there. The seasonality could drive a pullback, and there's a fundamental reason, if you like, if inflation is slightly stronger than expected. Let's start with the indices, beginning with the S&P 500. Currently trading at 5,007. We saw yet another record high yesterday on the S&P. It's becoming quite tedious now, really. The index marching higher along with the Nasdaq 100 and the Dow, even though Russell 2000 small cap picking up a bit. But we touched 5,049 on the S&P yesterday, which makes for a gain of about, 900 points or so, really. For the S&P. It's astonishing move higher really here. And as you can see, this trend line, which you could draw from the October lows, that's been tested a couple of times this year, but we're still firmly above it. And we are a long way away from the 50-day moving average. That's 4% away. And after the quiet, relentless rally we've had since November, really, it started off dramatic and then it slowed into a more sedate pace. But if we did see it, I'd say a 200-point drop in the space of a month or so, that would feel quite like a big fall. It would be the biggest fall in the index we've seen since October. So I think it's important to remember that while we are in an uptrend, we haven't had a decent pullback for quite some time. It doesn't mean one has to arrive, but it's just a risk, I think, at this point in time that you've seen. This morning you had reports from the Bank of America Fund Manager Survey, the tech stocks, most crowded trade. Once again, the biggest inflows to those since 2020. So investors have been piling back in, and that could lead to, ironically, a pullback, because a lot of the flows will then start to change. People late comers, this rally could see themselves caught out. So at the moment, it's almost not about the levels, it's about the macro and the flows we're seeing at the moment. Admittedly, there's very little sign of any downside movement in the S&P. As I say, even if we drop back to the trend line, that would be 49.50 or so. The previous highs, always a good one to watch for support, perhaps. Down at 4,800 as well from the middle of January. So that's another area to watch in the 50-day moving average in the short term. But at the moment, of course, as I say, little in the way of a move to the downside, which remains true of the Nasdaq as well. Down slightly so far this morning. Obviously, we had huge earnings last week and the week before, and that drove things to the upside. We did move above 18,000 here, and that cements about a 4,000 point gain for the Nasdaq. it's important. I'm looking at the monthly chart for the Nasdaq here this morning, actually, and you can see that 2023 was big up move into July, and then 3 downward months that seemed to get people all panicky, and then suddenly off we go again. And we're back at record highs. One of the most perfect uptrends you could ask for in financial markets is still intact. We tested the 50-month moving average. We held above it in January of 2023, and there was our consolidation and then our leap to new record highs over the next year. It really is a very impressive bounce. It could be testing trendline support from earlier in January, from the beginning of the year when we were down at 16,000, which seems a long way away in the short term. Break below that, and as I say, the previous highs we want to watch for. Well, in the first instance, 16,656, then down to 17,170, where the index found some support. That was the back to January of 2022 record highs, and then back down towards 16,978 as well. So something to bear in mind there. In the short term, the 50-day moving average 16,900. And as I say, after the quiet rally we've had, even if it dropped 5%, that wouldn't be a proper correction. But if it dropped 5%, it would feel, I think, a lot more dramatic. The last time we had a decent down move for the Nasdaq was the end of December, when it did lose 4% into the beginning of the year in thin trading. So one to watch for, really. And then it's not just US markets that are making record highs. Here is the Nikkei, which is determined, it seems, to make it back to these 1989-1990 highs just below 39,000. In the space of a week, we have taken out 36,000, 37,000, and 38,000 on the Nikkei, breaking through the previous high, or the previous multi-decade high from the end of January. It looked like it has further to run. It looks like it wants to get back to 39,000. But if the S&P and the Nasdaq look overextended, certainly the Nikkei does, moving 2,000 points in about 5 days. But it's still in a very strong uptrend. In the short term, pull back down towards trendline support again would wipe out those 2,000 points and feel like a big correction. Whether it goes much further remains to be seen. But with the yen remaining weak against the dollar, as we'll see in a second, and the argument that Japanese stocks are quite undervalued relative to their global peers. Also had big inflows into Japanese stocks last year, so that's driven finally beginning to show in the headline indices themselves. But a very, very strong performance here for the Nikkei, with the last hurdle now being 38,951. That's the high from 1990. Moving over to currency markets, and of course, yen very much in focus at the moment because of that Nikkei move. The euro has recovered quite a lot of ground against the yen. It's been quite a frustrating trade here because by the 1st of Feb, we were back where we were on the 30th of June. So essentially, it had gone nowhere in 6 months. It's oscillated around this point, 157.95. We've seen a new high for it in November. It had come back into December, but it's stabilized since then, finding support at the 200-day moving average. It was quite a messy low here. But eventually resolved in a move to the upside, and crucially this area around 158, for whatever reason, you can see back in September and October it was an area where buyers and sellers fought hard. Same thing happened in January, and indeed last week in February as well. So back on the up for this one. In the short term, we've got some trendline resistance to watch out for, which we're just testing as we speak today. So one to watch for. It comes at the odd time, really, because European data is so weak, you'd expect the Japanese yen to be stronger. But of course, because the BOJ is so cautious on what it does next with its monetary policy, it's given some room, at least in the short term, for the euro to move higher. Let's go to the dollar against the yen. Again, back on form, back in its uptrend after this big shakeout in November and December. Huge move to the downside, but didn't destroy the uptrend entirely. I think it did hold on. You had a higher low here after the one from July. And it was a very strong pullback, but it's recovered again. The price is telling you what to think here. Yes, it did go down a lot, but then recovered. It got back over the 200-day moving average. It steadily moved higher since then. It consolidated in mid-January, brief pullback, and then off we go again. So it wouldn't be surprising, I think, to see it trek back towards 152 over the course of time. Of course, if you get a strong US CPI print this afternoon, if it comes in ahead of expectations, you could expect the dollar to make further headway, and that might see us challenge 150 very, very soon. So one to watch for there as well. And then Chinese markets closed this week, but Aussie dollar, of course, a useful proxy for risk appetite in East Asia, doing its best to hold on, really. Took quite a bit of a knock over the past couple of weeks with that Fed meeting, and while they weren't really hawkish, they didn't really set the world ablaze with expectations for rate cuts. And that did knock the Aussie back quite dramatically. We had expected it, or is watching it forming some kind of short-term consolidation low in mid-January around 65.80, and then we knock back down towards 64.80. We've then since then tried to recover. You will note though that the rallies over the past week or so have faltered, not just around the 100-day moving average, but also around 65.30, which was the lows from mid-January, and also an area where in December the price found support. So previous support could be becoming resistance now, and certainly failure to close above 65.50 would be a worrying sign, I think, here. All to play for, though, I think, this afternoon with US CPI. So it will be volatile, probably across most FX pairs, as the market scrambles to reprice, should the data come in vastly different from expectations. And then finally, turning to commodity prices, gold, again, slightly weaker dollar this morning, helping gold to rally. It's doing its best to try and hold trendline support from early December. It's looking a bit dicey yesterday when it broke below it, but it's trying to break above it again today. It's not a great performance for gold, it has to be said. In fact, you could argue that there's maybe a trend line coming in here from that record high from the 4th of December. In the short term, we note that not only have you got trend line resistance from that December high, that rather surprising move to the 2120 highs before it was immediately reversed, but you've also got horizontal resistance coming up at 2060 if the prices rally, because gains in January and into February ran out of steam there. So if it can't get back above there, clearly that caps gains in the short term. If it closes back below, say, 2010, then that amplifies negative signal. But for commodities, as for FX, and indeed as for indices, US CPI sets the tone this afternoon. Now, having said that, it could be one of those days where it doesn't actually move very much, but it has been a volatile reading over the past year or more, and is likely to remain so. Whilst it isn't, of course, the Fed's preferred measure, that's PCE inflation, it is the one that the market pays most attention to. So you have to watch it regardless of what you're trading. And then finally to oil prices. Now, this one has continued to recover after a volatile end to January and the beginning to February, but it found the low at trendline support handily, for those who draw the trend line, from the December low. So that leaves that intact and bolsters the case for higher low. So really the next target becomes that late January high around $79 a barrel for WTI. Beyond that, you've also got some intermediate resistance around 79.80, just below 80, where spikes higher in November and in November, middle of November and late November, right at the end of November, ran into selling. So that clearly is a level that people are to sell at. We'll see what happens the next time it gets there. That's, of course, the key thing to remember with technical analysis and levels. We're not trying to predict what it will do. We're saying last time it was here, this happened, and it would be interesting to know if and when or it gets back to 79.70, what it does then. If it can break above it, that will be an interesting development. We'll wait and see. Certainly has been trending higher since late December, since early December rather. So the buyers would appear to have the upper hand for the time being. So, as I say, it is US CPI. I may have mentioned that this afternoon. The key event of the week, really. There's not much else driving markets at the moment. So that's the most important thing to watch to see how price growth is faring. You can expect it to be volatile as the market looks at the data and the underlying figures. So after a slightly mixed finish for markets yesterday with the Dow managing to finish the day up 125 but off its highs, we are expecting the Dow to open around about 50 points lower from yesterday's close, so that caution persists. But that could change, of course, dramatically around that US inflation print, so do bear that in mind. That'll be covered live as well on Beat the Street on IGTV as well. That's it for me. Thank you for joining us. We'll be back as normal tomorrow at 10:30.